Welcome to the Climate Policy Initiative webinar on blended finance and clean energy. This webinar will be presented by Bella Tonkonogy, Manager at CPI, and Alex Clark, Assistant Analyst at CPI. The format of this webinar will be a half-hour presentation followed by a question and answer session. All attendees will be on mute, but during this time, you are welcome to submit a question by typing them into the chat box on the lower right-hand corner of your screen, and we'll address them after the presentation. As a reminder, the webinar is being recorded and will be available online in the coming days. And now I will turn it over to Alex.
Thank you, Caroline. To everyone joining us for today's webinar, we're delighted to be sharing our findings with you. This report was published in January this year and is focused on lessons learned and opportunities in blended finance for clean energy. The report was commissioned by the Blended Finance Task Force, which is part of the Business and Sustainable Development Commission, alongside complementary studies on land use by Coyce Invest and the investor landscape by Convergence. The focus of the task force is on mobilizing private investment for the Sustainable Development Goals. It is intended to bring the voice of the private sector to parallel discussions of blended finance led by the OECD and the development finance institutions. Last week, the task force launched its action agenda for blended finance, which you can find online. The objective of the Climate Policy Initiative's deep dive into the clean energy sector was threefold. First, to understand the clean energy investment opportunity by examining countries, technologies, and investors with high potential and corresponding barriers to investment. Second, to map the current blended finance landscape, identifying trends, lessons learned, and gaps in blended finance offerings in clean energy to date. And finally, to recommend how blended finance can be better deployed to meet the opportunities identified. In this report, we look primarily at the use of blended finance in electricity generation, which includes renewable energy projects for both decarbonisation and electricity access, with some reference to energy efficiency where appropriate. So what is blended finance? We define blended finance here as the use of public or philanthropic funds to mobilise multiples of additional private capital. We focus on concessional capital extended at below market terms through lower interest rates and longer tenors, for example. This can be direct within the capital stack, such as first loss capital and concessional loans, or indirect to catalyse private investment, such as through guarantees and project preparation grants. The starting point here is the question of why blended finance is useful and the barriers to investment that it can help to address. Risks and barriers facing investors prevent the realization of investment opportunities in new technologies, business models, and many developing countries. Blended finance is a tool to address some of these barriers. It's a rapidly growing market at around $50 billion across all sectors currently. In particular, it can help to mainstream and mobilize additional private sector investment in impactful sectors, helping to scale impact more efficiently, effectively, and sustainably than public sector action alone. Blended finance can address risks in two main ways. On the one hand are pioneer risks, which can stem from a lack of understanding or experience with, or a lack of track record of a technology, business model, investment strategy, or asset class. Successful examples of blended finance can produce a demonstration effect, essentially showing that the project is viable, reducing risk perceptions, and building investor confidence over time, or transfer pioneer risk associated with being a first mover on a new technology or business model to the public sector. On the other hand, there are a range of risks that cannot be reduced just through implementing the project itself, but can be transferred to another party through a blended finance tool. The eventual aim is to phase out blended finance entirely and for the instrument to operate on a commercial basis. So why blended finance in clean energy? Blending can reallocate risk in clean energy finance so as to catalyze private sector investment that would otherwise not take place. Barriers to financing clean energy projects are complex and context specific. For this project, we updated past CPI work that had developed frameworks for assessing risks and barriers of clean energy investment. In this diagram, we quantitatively analyze the country-specific barriers facing investors in 3 countries of particular interest. Starting from the top, political and social risks can include corruption and governance risks and legal and ownership rights infringement risks. Administrative barriers refer mainly to bureaucratic, legal or procedural barriers that hamper project development and capital raising. Policy and regulatory risks refer to detrimental changes in the level of support given to clean energy projects, whether through tariffs or lower levels of subsidization. Project developers can also experience difficulties in accessing capital, either due to a lack of markets to raise from or a high cost of capital for financing and refinancing. Cost increases or volatility in costs at the construction, financial and operational stages of project development can also occur due to unforeseen challenges in deploying technologies and producing power, upstream risks on availability of materials, resources and workforce, and changes in the market environment that affect financing costs. Currency risk is related to unfavorable currency fluctuations occurring when projects are financed with loans in foreign currency but have revenues in local currency. Counterparty and off-taker risk refers to the inability of counterparties to honor contracted obligations due to the lack of enforceable collateral or unreliable counterparties. And finally, on the revenue side, low or volatile electricity prices, a lack of robust power purchase agreements, or insufficient expected returns can increase risk for investors. Key to note here is the range and variation of risks and barriers faced in different countries, and therefore the need to assess independently the most important risks in a country when designing a blended finance initiative. You can see in this chart, for example, how a key risk in India is counterparty risk, whereas a key risk in Kenya is in access to finance. Of the country risks we looked at, we found that investors were in general most concerned with off-taker risks and currency risks, although this does vary by market. On top of these country-specific risks, clean energy has particular features that can amplify the risks investors face. These include high risk at early stages of project development, as illustrated in the chart here, high upfront costs including legal, administrative, regulatory and capital costs, high transaction costs for investors, with the exception of the very largest projects, in many cases because of the due diligence required, a long time horizon of investments, and finally, for new technologies, business models and fund managers, a key barrier to attracting private sector interests is a lack of a track record and data to which investors can refer in allocating capital and pricing correctly. Of the clean energy risks, we found that investors were most concerned with the low liquidity and scale of many clean energy investment opportunities, as well as the risks involved in investing in early stage projects, technologies, and businesses. After conducting our assessment of the barriers to investment in clean energy, we turned to the blended finance landscape to identify where barriers are being addressed by blended finance and which initiatives are doing so most successfully, and to identify where the gaps are and which barriers are not being addressed. Clean energy has plenty of experience with the use of blended finance. It has played a significant role in accelerating cost declines and bringing emerging technologies towards commercial maturity in progressively more difficult markets. We've already seen impressive uses of blending in Mexico, Morocco, and China, among others. To understand what gaps remain in the market offerings, we looked at 75 blended finance initiatives in clean energy specifically. We found some gaps in terms of the types of risk mitigation that are being offered, effective mobilization of private capital, and meeting the demands of influential capital providers, particularly institutional investors. This chart presents the barriers addressed by the blended finance initiatives in clean energy that we examined in detail. The risks and barriers described here include the country-level risks as well as those specific to new technologies. First on the far left is information gaps. This refers to tools that address a lack of information flow between parties that prevents lenders from accurately assessing the creditworthiness of the counterparties to a transaction. The middle two categories, Commercial barriers and political barriers are country-level risks explained earlier. And on the right-hand side are technology and upstream risks. This refers to using blended finance to bridge viability gaps and underperformance, and resource risks for clean energy technologies. In particular, in our research, while we found many investors are concerned about off-taker risk and currency risk, we found that relatively few initiatives actually address them. While most initiatives incorporate the use of concessional debt, equity, or grants to de-risk investment, we found there is likely not enough use of guarantees relative to other instruments, despite their track record of effectiveness in mobilizing private investment. For example, a 2017 analysis of multilateral institutions indicated that guarantees represent just 5% of their commitments, but generate 45% of total private sector mobilization. So the question is, why are they not used enough? There are several, primarily administrative, reasons for this. The first is around risk allocation. Development finance institutions typically book guarantees in the same way as loans for the purposes of risk capital allocation, as if a guarantee were a loan exposure for 100% of the amount, discouraging their use over loans. Second, guarantees do not qualify as overseas development assistance or ODA under current OECD guidelines, reducing incentives for many development finance institutions to use them. Guarantees also have limitations under international bank regulations, which the Blended Finance Task Force is exploring more thoroughly. A successful example of the use of guarantees is an instrument from the Climate Policy Initiative's Global Innovation Lab for Climate Finance, known as Climate Investor One. One of its three-component funds received a guarantee from the Dutch export credit agency Atradius, covering currency and construction risks, along with a first loss equity tranche. Bella will return to Climate Investor One in more detail later in the presentation. Institutional investors include pension funds, sovereign wealth funds, family offices, and insurers. With over $30 trillion in assets under management, this is a particularly influential group and has significant potential to unlock finance for clean energy. Institutional investors typically seek to make large investments due to the due diligence costs associated with evaluating projects, a lower risk tolerance, and a preference for upstream channels. However, we found that most blended finance initiatives, whether at project or fund level, are concentrated at under $100 million in size, as you can see in the chart here, too small to attract institutional investors. The initiatives we studied that had attracted institutional investment were larger on average than those that hadn't. Now I'll hand over to my colleague Bella, who will look into some of the successful examples of blended finance and clean energy in more detail and highlight some of the key opportunities in the years ahead.
Great. Thank you so much, Alex, for the overview of the risk barriers and gaps in the blended finance landscape. So we're certainly not the first people to realize and research that there are some gaps here in blended finance. And in fact, a number of initiatives are recently underway to address some of these gaps and have begun to build a track record. This slide shows some of them, but there are many more that we note in our paper and in the annexes to the paper. So we hope that the rest of the presentation will leave you excited about the opportunities that lie ahead. So first, we wanted to give you a few concrete examples of some of these recent blended finance innovations. We'll discuss 3 blended finance vehicles which have been developed since 2014 with the support of the Global Innovation Lab for Climate Finance, which is a public-private partnership for which CPI acts as secretariat. We picked these because we happen to know a good deal about them, but I just want to note that there are a number of others outside the lab that we also profiled in our paper. So the first vehicle is Climate Investor One, which Alex just mentioned, and which was developed by a private equity manager, Climate Fund Managers, in partnership with the Netherlands Development Finance Institution, FMO. This vehicle seeks to reduce transaction costs across the renewable energy project lifecycle through the establishment of 3 interlinked funds that are focusing on sub-investment grade countries. Starting with the left-hand side of the diagram, a development fund is financed entirely by concessional funders with capital that will recycle back into the fund once successful projects move into construction. The projects that make it to construction are then eligible for up to 75% equity finance from the construction fund, which is a tiered blended structure. The top tier shown here, Tier 1, is a first loss concessional tranche, which absorbs the first losses of the fund, if any. The bottom tier shown here is the senior tranche, Tier 3, which is supported by a guarantee from the Dutch Export Credit Agency and will provide fixed returns to its institutional investors and development finance institution investors. The middle tier provides the highest returns but is also riskier than Tier 3. This fund has to date raised over $400 million, with institutional investors like pension funds participating in both Tiers 2 and 3. Once projects are operational, a refinance fund will be available to lower the cost of capital for the projects. The fund managers envision this model as scalable to other countries as well as to other sectors. The second vehicle is energy savings insurance, which is a financial instrument that addresses performance risk of energy efficiency investments. In particular, it addresses this investment barrier by paying out if the projected value of energy savings is not met. The lab's analysis shows that the instrument can absorb up to 80% of this underperformance risk, which you can see in the right-hand graphic. The instrument was proposed to the lab by the Inter-American Development Bank and has since been supported by the Danish Energy Agency and the Green Climate Fund, as well as the Basel Agency for Sustainable Energy, which is helping to replicate it. It has to date secured over $180 million in funding, with additional private sector partners expected to contribute further through project-level investments. The instrument is under implementation or development in at least 8 Latin American countries, with replications also planned in Africa, Asia, and Southern Europe by a number of institutions. The third and final vehicle we'll discuss is the long-term foreign exchange risk management facility, which addresses currency risk in renewable energy projects with a globally diversified currency hedging facility. The Currency Exchange Fund, or TCX, launched this renewable energy facility in 2015 with concessional funding from the German government, helping borrowers extend loans in local currency. For example, the facility worked with a financing partner, Responsibility, to finance a Kenyan solar energy provider, M-KOPA, which in turn extended loans to individuals to purchase solar energy systems in their local currency. This mechanism has helped the facility mobilize more than $200 million for renewable energy. Currently, TCX is working to scale this innovation through the development of a facility called the Common Risk Mitigation Mechanism. So, where do we go from here, and how do we keep driving transformational ideas to scale and into the mainstream? So, the rest of our presentation discusses some of the recommendations coming out of our report, as well as some potential applications in other sectors. So for this report, we analyzed the countries and regions that offer the most impactful investment opportunities for blended finance and clean energy specifically. We focused on sub-investment grade countries, which we defined as having the most need for blended finance. And although investment grade countries may still have some need, we didn't focus on them for this project. So we compared these sub-investment grade countries. We compared those with significant energy access and climate change mitigation potential, which we defined by a set of indicators looking at the impact per additional dollar, with the private sector investment environment of those countries as defined by several publicly available enabling environment indicators. So the first thing to say here is that although there are certainly high impact opportunities across the globe, We found that focusing on sub-Saharan Africa and South and Southeastern Asia can deliver the highest impact per dollar. And the 8 countries highlighted at the top right of this chart represent $360 billion of renewable energy investment opportunity based on their targets, and with India representing the largest share of this. The next tiers of countries also include countries like Indonesia, which are considered critical as well to addressing climate change. The second recommendation from the report is to ramp up use of instruments that are addressing the most critical risks and barriers to investors. Although this is highly context dependent, in our research we saw and heard repeatedly that we need more of the 3 categories of instruments shown on this slide. So first, we need risk mitigation instruments such as guarantees, insurance, and currency hedging, examples of which are used in the innovations I previously described. Second, instruments that help generate liquidity and scale. Instruments like bonds, investment trusts, and funds that can be traded by more mainstream investors and recycle capital to invest in new projects. Third, there continues to be great need for early-stage risk financing. Grid-connected renewable energy projects, early-stage off-grid energy companies, and new technologies all suffer from a shortage of capital at the earliest, riskiest stages. So blended finance is needed to help them bridge the gap to commercial success. And there are some very interesting examples of initiatives working on this today. So the third group of recommendations is probably the most difficult, as it is about getting innovative ideas from pilot to scale in a way that is sustainable in the long term. The first point here is simple in concept but can be difficult in practice. The concept is that if an idea is working, help it grow. And we didn't discuss too much the mechanisms for replication and scale in this report, and many others have written far more on this topic. But I'll say that we've seen with the 3 instruments I mentioned, as well as several others, different pathways to replication and scale. And as instruments scale, they should ideally phase out their concessionality over time as the business models are proven and countries' macroeconomic environments improve. Much of this, therefore, also requires improvements in enabling environments through policy and regulatory change to accompany the financial innovation. So the second bullet on the slide is that successful blended finance deals typically require someone actively bringing together the disparate parties. And these intermediaries need support, both technical and financial. These can be private sector fund managers, such as climate fund managers of Climate Investor One, which spent 3 years and several $1,000,000 assembling the public and private investors into its fund, or the European Investment Bank's GREF team, which approached nearly 1,000 potential investors. It can mean neutral intermediaries that focus on identifying and screening deals for groups of investors, like the Prime Coalition and Aligned Intermediary, which are both based in the US, or the lab that CPI manages. Or they can be financial intermediaries like local banks that help bridge the divide between international development finance institutions and local small and medium-sized enterprises. The final bullet on this slide is that we've heard repeatedly of barriers to implementation and scale that are more institutional in nature. These can range from high transaction costs for getting approvals from public sector organizations to incentive misalignment within institutions so that the largest deals are prioritized rather than the deals that mobilize the most private capital, and finally to a lack of standardization inflating costs. These are very difficult to address, but would help especially reduce the long lead times and high development costs required to get ideas off the ground and to scale. For example, the Blended Finance Task Force has proposed that development finance institutions set private sector mobilization targets, which would help drive these types of institutional changes. So finally, while this report focused on our collective experiences in blended finance for clean energy, we see great opportunity as well in applying the lessons learned from clean energy blended finance implementation to other sectors that are in a more nascent stage of development. In particular, many in the blended finance world want to see how we can apply these lessons more to adaptation, to cities, and to sustainable land use. And even though our report dealt somewhat with energy access, far more work could be done to dig into and develop effective models here. And there are a number of efforts underway, including by the lab, the Blended Finance Task Force, and many philanthropic and public organizations to increase focus in these areas. So thank you so much for your attention. We'll now move into Q&A, for which I'll turn it back over to our moderator, Caroline.
Thank you, Bella. We will now take a minute or two to collect questions. As a reminder, you can type your questions in the chat box in the lower right-hand corner of your screen. Enters are, what are your recommendations to attract institutional investors if the transaction amounts are too low?
Okay, thank you so much, Caroline. I can start with that one. So this is a really interesting question because institutional investors, as Alex mentioned, manage or own the greatest share of financial assets globally, but they're notoriously difficult to attract into new sectors or into sectors like clean energy. And this is because most of their resources are going into very plain vanilla investments. So, bonds and stocks that are traded on national or global markets, just like you and I could trade. I mean, they have, in addition to those kind of bond and stock portfolios, they also have, many of them have started in particular in the last several years to ramp up what they call their alternatives portfolios, which are able to invest more in real assets like real estate and clean energy and other infrastructure investments. But these tend to be a very small share of their overall investment portfolios. And for most institutional investors, even those that are based in developing countries, they're still investing most of their assets into developed countries, even among their alternatives portfolios. So at the end of the day, there's a very small amount that's really available for these alternative clean energy or infrastructure investments in developing countries in particular. So where we've seen that they have been successful, that these blended finance initiatives have been successful in attracting institutional investment, I think is twofold. I mean, one is in targeting these alternative investment allocations of institutional investors. These have been the large funds like Climate Investor One. IFC has another large fund large managed fund that they've launched in the last year. GREF from the European Investment Bank was able to attract some investment from institutional investors. These funds tend to be at least $250 million in size, many targeting much larger sizes. I think the IFC initiative I mentioned is $500 million for each of its funds that it's developing. So these are sort of the large funds that have been able to attract institutional investors. Many of them also carry a guarantee for these institutional investors, like Climate Investor One that I mentioned. The other area of development that I think is really is really needed more and needs more substantiation within developing countries, and which has started in developed countries, is more the aggregation of smaller investments. So say, for example, a green bank that has loaned money to many, many different small and medium enterprises can aggregate, can securitize and aggregate those smaller investments into a larger product that it can then sell to institutional investors. The other opportunity here is also in increasing or improving the ability of companies, and in particular utilities, to sell their own corporate um, bonds onto markets that institutional investors can buy.
Great, thanks, Bella. Could you say a bit more about blended finance approaches or experiences for energy access?
Sure, I can start and then I'll turn it over to Alex to add a little bit more detail here. So energy access is pretty interesting. We didn't look at it in too much detail in this report, but one thing we heard from a number of interviewees. We talked to a number of investors and emerging markets experts for their support. And one thing we kind of heard repeatedly was with energy access, and in particular with energy access that's focused on the off-grid energy sector, is that the needs are really different from, say, more large-scale grid-connected renewable energy projects. So the large scale renewable energy projects are infrastructure investments, but with these energy access investments, most of them are corporate finance. So it's investing into companies that are offering and selling, say, small scale solar energy systems. So their needs are going to be different. A lot of them need early stage risk capital, so more like a venture capital investment. These kinds of investments into smaller companies are notoriously difficult for development finance institutions, which are large, and it's very hard to assess the risks and ability of these smaller enterprises. So one thing that we've seen a number of people are working on is how to work through financial institutional intermediaries like local banks to help them then extend credit to these smaller companies. So the African Development Bank has a new facility called the Facility for Energy Inclusion that's focusing on this. And I'll turn over to Alex to talk about Energy Access Ventures, which we developed a case study for in the report.
Thank you, Bella. Yeah, I'll just go into a little bit more detail on Energy Access Ventures. Energy Access Ventures focuses on rooftop solar markets, primarily in sub-Saharan Africa, in countries including Ethiopia, Kenya, Mozambique, Rwanda. And it provides flexible equity and technical assistance and grants where they're required, with the aim of growing portfolio companies' strategy and their team, raising further funding and developing exit plans. And also providing skilled personnel, impact assessments, and compliance advice. So the focus is very much on the upfront costs and dealing with the aforementioned information gaps between the various parties to potential transactions. The targets businesses here are small renewable energy businesses specializing in low-cost electricity access in rural areas that cannot otherwise access financing. And another initiative worth highlighting is the Africa Clean Energy Finance Initiative, or ACEF, which takes a slightly different approach in being more of a project preparation facility with the purpose of primarily meeting upfront costs, including regulatory and administrative costs, for otherwise commercially viable clean energy projects. And this involves, in this particular case, involvement of the US OPIC, the Overseas Private Investment Corporation.
Great. Thank you, Caroline. I think, or thank you, Alex, excuse me. I think we can take this question with respect to off-taker risk that that someone asked regarding Vietnam. So for that one, I don't have specific examples from Vietnam, but we have seen some interesting examples in other countries. In particular, the Indian government has experimented with payment security mechanisms which help guarantee and reduce off-taker risk. And so, potentially a similar approach could be applied in Vietnam or through a third-party guarantee from the World Bank or something like that. I can take this other question as well with respect to energy efficiency technologies that have been covered by energy savings insurance, and have there been any claims? So the energy savings insurance is still in the early stages of implementation. So it is at the point where um, it's basically in the stages of pipeline development. So working with the local financial institutions to develop the loan products that would be um, lended to the small and medium enterprises, and working with the insurance companies to develop the insurance products. So that's been ongoing in a number of different countries. And so I'm not aware of any specific examples yet that have come out from that, but I'm certainly happy, or I think if you go on our website, you can climatefinancelab.org and go to the idea page for energy savings insurance. You can find the contact information for the implementers of that product. We can take this question on green climate funds. Um, you know, I'm not sure that in our research, or well, certainly in our research and our other work, we haven't done any work as to sort of the strategy for the Green Climate Fund, and sort of, all of the different needs that it's meeting, both in terms of supporting the public sector and the private sector. But I do know that it has the Green Climate Fund is experimenting with a number of different potential ways to support um, blended finance. In particular, they had a request for proposals last year to the private sector, which they called Pitch for the Planet. And they received, I think, over 300 proposals from that. It was a global call for proposals. And they are going ahead with the top 30 or so of those proposals. And so many of those were kind of different initiatives and different ideas on blended finance for climate change. So that includes clean energy, but it also includes other climate change mitigation sectors like agriculture and forestry, as well as climate change adaptation. So I would just say to watch that space and see kind of what comes out of that experimentation, and to see how the Green Climate Fund evolves in its support of blended finance in the coming years. It is still a very young institution, so definitely looking forward to seeing how it can play a
Just to add briefly to that, in our blended finance landscape analysis, we did come across two particular cases where the GCF is involved, if you'd like to look into them in further detail. The first is the Kawi Safi Ventures Fund in East Africa, or KSVF, which is a privately managed fund. And the second is the Universal Green Energy Access Program, or UGEAP, which again is a privately managed fund.
I think there are a few questions here that are about sort of how do you access blended finance, right? So if you're somebody with an idea or project, how do you actually find the financing for that project and idea? That one is it's a it's an int- it's a very context specific question. I mean, I think it depends on the country in which you're operating, um, and in which your project is under development. So, as we talked about Climate Investor One, which is, actively developing a pipeline and looking for projects in a number of different sub-investment grade countries. Um, they've already invested in a project in Zambia, for example, and they're actively looking to increase their pipeline. There are, we also work a lot, CPI also works a lot in India, where we have an office and a number of research and implementation projects underway. And, there are a number of different opportunities there. Um, I would say that, yeah, so if you have a project that's looking for blended finance, it's really kind of about understanding and doing some research on the landscape of blended finance opportunities. We listed in the annex to the report all of the blended finance initiatives that we analyzed, so you could probably start there. There's a kind of similar question as well about, how a lot of small and medium enterprises need to have strong business cases to attract investment, but often lack the expertise in that in order to attract the investment. Again, I mean, our report didn't focus on this topic too much, but we focused on the opposite side, which is how to better how blended finance initiatives can be most effective. And one of the areas that we dove into and formed one of the recommendations in the report is around including and incorporating technical assistance in blended finance initiatives, and in particular, in including technical assistance in a way that helps um, businesses and financial intermediaries during the implementation of a project. So, there are a number of, for example, blended finance, private equity funds that have um, a sidecar or an attached technical assistance facility, and that technical assistance facility is intended to help the businesses that are either pre-investment from the fund or post-investment improve their management, their governance, their internal capabilities be in order to be sort of more investable, say, or more likely to succeed as they expand and increase. So a number of blended finance funds include this type of technical assistance in them. We also see, for example, in Climate Investor One, that they include technical assistance to the project developers um, that in order to help them develop projects that meet sort of international environmental and social performance standards, and to help them develop better, again, projects that are more likely to succeed and to get to the next level.
Just to add to the last discussion, there's a fairly major blended finance initiative that's been through several iterations, known as the China Utility-Based Energy Efficiency Program, or CHUE, CHUEE, which has been through three separate iterations, and was in theory supposed to initially focus on using national banks as intermediaries to finance energy efficiency investments in small and medium enterprises in China, with a external guarantee from the IFC for any potential losses incurred. The first iteration focused, or at least the evaluation concluded that it focused excessively on non-additional investments, so those that would have happened anyway. But since then, the project has been refined to focus more on the smaller end of enterprises seeking energy efficiency investments. So while this isn't a technical assistance or project preparation facility per se, it is a very strong indication of the need to effectively build bank lending confidence in energy efficiency investments. And most notably, as of the most recent evaluation, 0% of the portfolios in question were in default.
I just wanted to add a little bit of information to my comments on the energy savings insurance instrument. There was a few questions about specific types of companies that are making use of the insurance product, and I didn't have the information in front of me, but I do have a couple examples now. So we do have three examples. One is a pig farm, which was looking to replace or improve the energy efficiency of its motors, which applied for a loan with accompanying insurance, a coconut oil manufacturer looking again to increase the efficiency of its use of biomass, and a mango fruit packaging company. So those are just a couple of examples of the types of companies, the small and medium enterprises that are applying for loans with accompanying insurance products.
Thank you, Bella. Thank you very much to our presenters for the great presentation and to all of our participants for your interest and questions. If we weren't able to get to your question today, please feel free to reach out to either Bella or Alex directly by using their email addresses on the screen here. Thank you.